Again, welcome and good afternoon, everybody. Can everyone see the slides all right and hear me okay today? I'll presume that that's an okay answer. So again, this is Emily Kovarik. I am the Chief Financial Officer with the Montana Community Foundation. I am a CPA, and I've been working with MCF for 5 years now. Including my career here at MCF, I have been working in nonprofit financial leadership in Montana for 13 years, since 2002. Prior to my work in Montana's nonprofit sector, I was a lead auditor with KPMG LLP, one of the 4 leading accounting firms in the world. And my education background is I have my Bachelor of Business Administration with an emphasis in accounting from Gonzaga University. Today I'm conducting this webinar with the goal of being able to be a resource to the nonprofits in the state and increasing knowledge and understanding of agency endowments for all of us in Montana. The topics that we're going to be covered in today's webinar will be, we're going to talk about what is an agency endowment, who can establish one, how do agency endowments specifically at MCF benefit a nonprofit, and the nitty-gritty details of what are the accounting rules and what are the tax reporting rules. I'm saving the good stuff for last. In compiling this webinar, the sources of the technical guidance that were used were directly from the Federal Accounting Standards Board, FASB, references to IRS publications and IRS Form 990 instructions specifically. A lot of review and consult was done with the Council on Foundations, and there are many publications and training materials that I have access to as MCF as a member of the Council on Foundations. And also, the detail in this webinar was reviewed for technical accuracy by Moss Adams, who is our audit and tax advisors. So let's get started. What is an agency endowment? An agency endowment is a type of donor, or is a type of designated fund, and the donor is the nonprofit itself. Many of you are probably familiar with what an endowment is, and typically we have an outside public individual or business or corporation giving a gift. This is a bit different because an agency endowment just has the nonprofit giving the gift. And what that nonprofit's gift is comprised of is that it has available unrestricted funds that it wants to permanently invest in an endowment to benefit itself. So as that money flows to the community foundation, the community foundation accepts that gift from the nonprofit, and we invest it permanently in an endowment that's designated for that nonprofit donor. So in establishing agency endowments, it's a definite testament to the commitment of the future of the nonprofit when a nonprofit does decide to establish an agency endowment. It's showing that it has a belief in how that nonprofit will continue to exist and also to provide a means of helping support the operational and charitable goals of that nonprofit and its community in the future. Next is the variance power. Has to be granted to the community foundation. And what variance power is that it is the power that is held by the governing body of the community foundation to modify any restriction or condition on the distribution of funds for a specified charitable purpose. And it's up to, or for charitable purpose or specified organization, if in the judgment of the community foundation body that restriction or condition becomes unnecessary or incapable of fulfillment, or perhaps inconsistent with the charitable needs. variance power is a really important piece of an agency endowment. It's an important piece of all endowment agreements that we have with donors and with nonprofits. The national standards for U.S. community foundations requires that variance power appear in a fund agreement. And because the agency endowment comes with the legal restriction that distributions from the fund will benefit that named agency, the fund agreement is needed to include the variance power. Also, legal ownership is transferred to the community foundation in establishing an agency endowment. So one might ask if it's prudent for a nonprofit board in exercising its own fiduciary responsibilities, whether it's a prudent move to establish a fund at a community foundation, and indeed it is, and the Community Foundation Council on Foundations group discusses that, and they talk that it can be a very prudent move and consistent with the fiduciary responsibilities of the non-for-profit board because of the benefits that are provided as a result of the relationship with the community foundation. So next we'll talk about who can establish an agency endowment. Indeed, it's any public charity that is listed under the IRS sections 509A1, 509A2, or 509A3. And as you see from my slide, I described 509A1, which most of the organizations that we work with include groups that receive public support from a broad, diverse group of the public. These could be churches, schools, hospitals, and other organizations. 509A2 organizations are a bit different because they're receiving the primary piece of their revenue from services, such as with museums and zoos. And finally, a 509A1 is a supporting organization that exists and resides underneath the umbrella of a 509A1 or 509A2. And also, it's great to note that government units can establish an agency endowment. How do agency endowments at Montana Community Foundation benefit a nonprofit? One of the things I'd like to highlight to the group today is the expertise of Montana Community Foundation. We have been doing this business of stewarding charitable assets for over 25 years in Montana. We have a great track record in prudently and in a very positive way managing the assets that are under our stewardship. Also, the expertise we have in-house includes our plan giving expertise, and I have with me participating in the call and listening in today, Amy Sullivan, who is our Director of the Montana Office of Gift Planning. So many of our nonprofits that we work with have an agency endowment, but they also have a donor-designated endowment. And sometimes, you may have a donor come to you willing to give an unrestricted gift, and if chosen, the board of your nonprofit could share those unrestricted gifts and deposit them to the agency endowment, but perhaps you might have a donor who would want to take advantage of the endowment tax credit. Working with us and on the donor-designated endowment side, we can help provide that plan giving expertise along the way, like with the work of Amy and her staff. Also, the experience of the Montana Community Foundation. We currently are managing over $9 million in agency endowments in 74 distinct funds that benefit 63 nonprofits all across Montana. We're really proud of the work that we do with all of you, and we hope to continue being a strong and improving partner in the future. Another really great thing we're proud of is our access to some of the most prominent investment managers and one of the most well-respected brokerage firms in the country, and that is Anderson, Hedge, Wagner and Associates of Merrill Lynch Global Wealth Management in Billings.
Yeah,
and we've been working with them for a number of years now, and they have helped steer our and advise on our investing policies and help keep us abreast of the best and latest changes happening. Also, we do have low investment fees. We are constantly striving to improve and decrease our management fees, and we've achieved a recent reduction in fees in last quarter, and our management fees are down to 0.5 to 40 to 50 basis points. And overall, of course, then on top of that, MCF does charge a management fee to help us do our work across the state to increase philanthropy. And our management fees currently on agency funds are 1.25% or less, depending on the size of the endowment, and that is an annual rate. Also, one of the great benefits in working with MCF and having an agency endowment here is that you can partner with us in building philanthropy in Montana. An important aspect also to consider is that we at MCF have the ability to be very flexible in the type of non-cash contributions that can be given. And so, for example, if your nonprofit were approached by a donor who had a piece of land that they wanted to gift, but you were unable to, perhaps under your own board direction, unable to accept that type of gift or liquidate it, that is something that could be gifted to the Montana Community Foundation. We have procedures in place and expertise on staff to negotiate and navigate those types of gifts, and we would be able to work with you to accept that gift and liquidate and deposit those funds and proceeds into your agency endowment. Also, an important part I'd like to mention is the idea that when you place assets in an agency endowment at MCF, you are protecting those assets. We all know that as our nonprofits go through their life cycles, different board members or even staff can have differing opinions on whether or not they want to really take current assets and place them aside for future use. So by placing them here at a separate organization, you do protect those assets from deviation from a long-term stability or long-term sustainability vision of the nonprofit. And last but not least, I think it's nice to note that having the agency endowment here does release your board members from the fiduciary responsibility of overseeing that endowment. That responsibility resides with the MCF's board of directors. Before we move on to the accounting and tax fund side of agency endowments, I do want to offer an opportunity for any questions at this time. Okay, hearing none, we'll go ahead and move on. So, accounting rules. Here we go. So, it's the elephant in the room, or at least I like to think so. It's the FASB, our Financial Accounting Standards Board. Years ago, they issued the pronouncement Statement of Accounting Standards number 136 that discusses the transfers of assets to a nonprofit organization or charitable trust that raises or holds contributions for others. This rule has caused, lots of angst, I think, amongst those of us who have to deal with it, and my goal today is to help you feel more comfortable and knowledgeable about how this applies to your organization and how you can be best in reporting and doing everything appropriately. A little bit of background. As many of you are probably aware, FASB over the years releases rules along the way to help clarify and guide the accounting and reporting in the United States. And ultimately, we have to go all the way back to 1993 when FASB issued FAS 116, which defined accounting for contributions, and FAS 117, which clarified and discussed the financial statements of a nonprofit. These were revolutionary changes in financial reporting for all nonprofits. And as organizations started to implement these two standards, serious practice issues arose relating to the applicability of FAS 116 to certain gifts made to community foundations in particular. So, following FASB's issuance of FAS 116 and FAS 117, the Council on Foundations, their Community Foundation Fiscal and Administrative Officers Group, commonly known as FOG, formed a task force to develop uniform guidance for community foundations in implementing the FASB standards. As the FOG group went through their work and sought input from Big Six accounting firms, the Big Six accounting firms were having different views with FASB on how they thought FAS 116 should be implemented and how it would be impacting community foundations. And all of this discussion led to FASB researching the issue, and ultimately they issued FAS 136 in June 1999. Since the issuance, we no longer actually can find FAS 136 in the FASB coffers because they've redesigned how all of the rules are categorized. And actually, it's much more intuitive now. If you were to go to the FASB website, you can actually sign up for a basic view membership for free and can go to FASB ASC Section 958-605, and in Sections 15 and 25 is where they talk in most detail about the guidance for these transfers and agency endowments. So to paraphrase the final piece of this slide, the standard it discusses how to accept a contribution from a donor, that when you agree to return a portion of those assets back to that donor. And that's what exactly is happening with an agency endowment, because the nonprofit is naming themselves as a beneficiary. So every year, as MCF or Community Foundation manages the endowment and does the endowment payout, that portion is being, or a portion of that endowment is always being returned to that nonprofit. So in light of that, the accounting arena decided that this was considered a reciprocal transaction. Some of the key points of FAS 136 is that variance power needs to be clearly stated in the gift instrument. And it's important to note that the IRS considers a completed gift to have been made by the nonprofit when that gift of assets comes to the community foundation. But FASB considers the gift to be reciprocal in nature, as I was discussing before, because this portion of assets given are returned with interest each year when the community foundation distributes those endowment earnings back to the donor nonprofit. And therefore, we have a book-to-tax difference in reporting. And really, once you think about it, it is clear as black and white. Now I'd like to actually go through specific accounting entries, and I'm hopeful that this will be, for many of you, hopefully nothing new, but if at any rate, very clear and helpful at the same time. So when we discuss and account for the creation of the fund, we can actually find the guidance specifically within FASB, as I've cited here in this example. And when that fund is created, we have to show a transfer of assets to the community foundation. And so to do so, you're going to take your cash. I'm assuming most nonprofits would be making a gift of cash. So you would be crediting your cash, and then on your balance sheet, you're going to go ahead and record a debit to beneficial interest in asset held by XYZ Community Foundation. And you'll note that I show that this the beneficial interest is actually going to be classified as a permanently restricted net asset. And the reason that is because the nonprofit does not have the right to request the money to be returned. It is permanently restricted, and it should be classified as such on your financial statements. So one of the interesting parts of this, of course, is that as we look at the accounting entries, when you first brought those cash gifts in or stock gifts from your donors, and perhaps your board is meeting throughout the year and you've decided that, gosh, there's some extra money here, we'd like to sock it away for future use to grow our endowment at the Community Foundation. So those gifts came in unrestricted, and we have to be able to show on our books how we've now allowed them to become restricted. So what you would want to do here is book it through an account on our books here at the Community Foundation, and with the approval of our auditors, we have an account named Reclassification of Net Assets. It's not a release, because you can't really go from unrestricted to permanently as a release. So it's a reclassification, and this is a GAAP-approved method of transaction. So in this case, you would be debiting the reclassification, you'd be showing an expense to your unrestricted funds by debiting reclassification of net assets and crediting your asset that you're getting ready to contribute to the Montana Community Foundation in our case. And secondly, you would then need to show that those assets are now restricted. So you're going to debit your cash and credit reclassification of net assets. Any questions on that slide? All right. So in looking at the financial activity of the fund, the nonprofit's interest in the endowment at a community foundation is very similar to if an organization had an interest in a perpetual trust. So in this case, your nonprofit organization has an interest in the future income stream from the trust. And as with a perpetual trust, the nonprofit doesn't have access to the principal value of the assets held, and that's outlined in the fund agreement. But what you do is that over the course of the life of the fund, you account for the changes in the value and distributions from the assets held at the community foundation. One of the primary entries that are going to occur during the lifetime of the agency endowment is doing a periodic endowment valuation change entry. And in this case, you would be debiting your beneficial interest in assets held and then crediting your investment gain or loss. And note that both of these entries would be done within the fund category of permanently restricted net assets. Of course, in the unfortunate instance that there might be a loss on the endowment and not a gain, you would be reversing these entries. Next main entry that occurs within an agency endowment would be the annual endowment payout distribution that happens. With this, as a community foundation makes distributions of income back to the nonprofit donor, you would do an entry to just debit unrestricted cash and credit investment income. There are some organizations that prefer to credit maybe a grant income, but that's not as appropriate. According to the guidance that I researched, the FASB declares that the appropriate credit would be to investment income. Then we move on to accounting disclosure. So for those of you that perhaps go through an audit or at least internally are preparing a full set of GAAP financial statements that include the actual financial reports as well as footnotes for disclosure, this is the guidance that would help show you what you need to present and disclose in the footnotes to your financial statements. With that, FASB does ask and require that the interests and the assets that are held at the community foundation are carried at fair value. So that's, as we think of that, that's what, on our balance sheet when we have to declare a value to classify all of our assets in, we have to actually assess a fair market value for this. For any of you with any significant level of investments, you would know that your auditors require you to classify these into levels 1, levels 2, or level 3 fair value measurement. Level 1 being readily tradable marketable securities such as common stock. Obviously, cash is a level 1. A level 2 classification is a little more difficult to determine fair value of. And level 3 is the most restrictive. And the guidance in FASB declares that actually the value of your agency endowment is supposed to be presented as a level 3 fair value measurement. And the reason for that is that the nonprofit agency does not have the ability to redeem its investment, meaning the agency endowment, with the investee, the community foundation, at the net asset value per share amount. So because of that, then the fair market value measurement of the investment is to be shown as a level 3. Then in just general disclosure in your financial statements, this is where you get to talk more about the endowments that you do have. And this is where there's 4 parts that need to be identified. And in your footnotes, you would want to identify the community foundation that's holding the endowments, whether it be your agency endowment or perhaps your nonprofit also has a donor-designated endowment. Number 2, you want to be able to disclose that the terms under which the community foundation will distribute amounts to the nonprofit. And basically that is the annual endowment distribution, which is subject to the payout policy approved by the community foundation's board of directors. Third, in your footnotes, you will want to declare a statement that talks about the variance power that is gifted or granted to the community foundation and describe what that is. And there's some good example wording that FASB puts out there for us to consider. I won't read through the long one, but in summary, you could even keep it pretty short and sweet and just say that the Community Foundation Board has full authority to vary the terms of the endowment as appropriate. And lastly, the 4th item you'll want to disclose in your footnotes is the aggregate amount that is reported in the Statement of Financial Position and how that amount is described. In this, the suggested wording is to declare it as a beneficial interest in assets held by XYZ Community Foundation. So one thing I'd like to add as an additional notation at this time is, as we talk about variance power and exercising variance power, in the history of Montana Community Foundation, very, very rarely does our board of directors need to exercise variance power. The few times that we do is when, most of the time, is when a not-for-profit loses its 501c3 status or actually ceases to exist. And our commitment, of course, is to the original donor of those funds to continue to use that money for charitable purpose. So in those instances, when those nonprofits no longer are there, we petition the Attorney General, the state of Montana, and we tell them that this change has occurred, that the Board of Directors of the Community Foundation are desiring to find a suitable replacement. And in our proposal to the AG, we've already identified who a similar nonprofit would be. And then we wait for the Attorney General's approval before we make that change. And I think that's an important aspect of this relationship to note, is that we are not in the business of taking assets and then not honoring who the original donor is or what the original intent is. I mean, that's what we're all about here, is honoring donor intent and maintaining the integrity of what those donations are for. So. All right, now we get to move on to tax reporting rules. Fearing the IRS. I don't know about you guys, but as I first came here and learned more about 990 reporting, especially with these agency endowments, it was a little complex at first. But as we move on to talking about this, I just want to say, with Form 990 reporting, don't be scared. It can be a little confusing at first, but with hopefully the information I'm going to share with you today, as well as you consulting with your own tax advisors, we can all get to a point of properly and accurately reflecting agency endowments on the nonprofit organization's tax reports, as well as that it matches and offsets appropriately with how Montana Community Foundation presents those agency endowments. Accounting treatment that's mandated by FASB, as we just discussed at great lengths of detail, only impacts financial statements prepared in accordance with GAAP. And so it does not affect the legal and therefore the IRS treatment of contributions to and grants from agency endowments. Because of this, then, a book-to-tax reporting difference does exist between what is on your books and what will be in your 990. The first section I'd like to talk about is Part 8, the Statement of Revenue. This is towards the front of your 990. And in this, the revenue and expense entries that you've recorded, which are the entries that we talked about before for the periodic endowment valuation changes, when I send a statement to you and you see the investment income that's come in that quarter, and then also the annual endowment payout distributions that occur every spring. Those entries that you've recorded on your books are actual reconciling items between your nonprofit's audited financials and your 990. And the place that you're going to report those is in Schedule D. And the Schedule D is the Supplemental Financial Statements, Part 11. And it's appropriately and declared as being the reconciliation of revenue for the audited financial statements with your revenue per your return. And that is where you'll show those entries to get from your 990 amounts reported to what your audited financial statements show. The next section of the 990 that's impacted by your agency endowments is Part 9, Statement of Functional Expense. So on that Statement of Functional Expense, when your nonprofit makes a contribution to an agency endowment and you grant variance power to the community foundation, you actually would report it as a grant. Now keep in mind that doesn't match what your book said, because we talked on your books about you would actually be debiting an asset and crediting your cash or what have you that you transferred to the community foundation. So this is kind of like having an entry just on your 990. So what you would do is you would record a grant in your Statement of Functional Expense, and also you would get to record and list this grant in your Schedule I. So that grant is recorded to reflect the transfer of the assets that the nonprofit gave to the community foundation to invest in its agency endowment. So therefore, again, this is also going to be a reconciling item that would be reported in Schedule D, where you reconcile from the expenses in your audited financial statements to the revenue per your return. The balance sheet, on the other hand, is actually presented consistent with your audited financial statement presentation. I found this interesting as I did research over recent years to make sure I was doing this correctly on our side, but indeed, with guidance from Moss Adams and Community Council on Foundations, this is the appropriate way to do it. So your statement of financial position per your books and per your 990 is going to be the same. It's just your statement of activities that differs. And because it's the same, you still get to show and present in your 990 the line item of beneficial interest in assets held by, in our example, Montana Community Foundation. The first schedule that's impacted by agency endowments is the Schedule A, which is your public charity status and public support test schedule. And it's important to note that if you bring in unrestricted contributions that your board later decides to move into an agency endowment, those unrestricted contributions are definitely public support that you get to count towards your public support test. So you would include those contributions in your public support test. So interestingly enough, what this means is that to the IRS, it is a completed gift. So when the nonprofit group brings in unrestricted donations, even if it later goes to an agency endowment, the nonprofit on your side records it as public charity support. And also on the side of the community foundation, because it's considered a completed gift per the IRS, we too record it as a contribution. And on our side, it's a permanently restricted contribution. The next schedule that's impacted is Schedule D, which is the supplemental financial statements. This is where there's a question that talks about endowments. And you might recall, it has a beginning of year balance, there's contributions, then investment earnings, there's a current year, prior year, 2 years back, 3 years back, 4 years back. It's kind of a big section of that Schedule D. And nonprofits that are the beneficiary of an agency endowment held by the community foundation actually should not report them as endowments in Schedule D. And the reason is that the nonprofits, although you're a beneficiary of the agency endowment, you do not hold the assets. And so therefore, you don't report them in Question 1. Now going down further into this Part 5 endowment fund section of that schedule, it does ask the question, are there endowment funds in the possession of the organization that are held and administered for the organization by 1, unrelated organizations, or 2, related organizations? Your nonprofit can answer yes to 1, an unrelated organization, because in our case, in our relationship with all of you, MCF is not a related organization. We're unrelated. So you could answer yes to question 3A1. And last, in that Part 5 section of endowment funds, a question is asked in number 4. Describe in Part 8 the intended uses of the organization's endowment funds. And this is where you can describe in your 990 that your nonprofit's the beneficiary of an agency endowment at XYZ Community Foundation, and that your nonprofit annually receives an endowment distribution used to support your operations. You might recall earlier in the webinar we talked about the fact that on the 990 side, when you make a gift to the Community Foundation, you would record it as a grant in your 990. And so in Schedule I, the grants detailed schedule, you can actually disclose this. And you can include that grant to the Community Foundation. Whoops. So at this time, I'd like to open it up for questions. I do want to state the disclosure that, while I am a resource for all of you here, the guidance I've presented here is not to be relied upon for avoiding any penalties with the IRS, but it hopefully has been informative for you. Are there any questions I can answer? No one's biting at this time? That's all right. I hope that this hasn't been too overwhelming, but hopefully informative for all of you. We do have a frequently asked questions document that's available for all nonprofits. And if you're interested in having that or haven't received it from us already, please let me know. It is a guide that we've put together here at MCF that has had technical review from Moss Adams, and it's very, very helpful. It answers more questions than my webinar, but also includes all of the same accounting entries and 990 guidance that we covered in the webinar. If you do have any other questions or want more information, please contact me. I am always happy to help, and we all here at MCF want to be resources to the nonprofit community in the state, and we welcome you contacting us. Just to let you know as well that a recording of the webinar will be available on mtcf.org in a few days. So if you'd like to have other staff at your organization listen to it or share it with your financial or accounting advisor, you're welcome to do so. And with that, I'd like to thank all of you for listening in today. You've been a very quiet and attentive audience, and I wish you all a wonderful afternoon. Stay warm out there.